Hey, what's going on, guys? It's Sal Bossio with Mortgage Universe, where real deals get done. So today I want to talk about the DSCR cash out. This is how your Uncle John has 27 properties at 37 years old and doesn't have to work another day in his life. It's the DSCR loan. Now, we talked about this, or I discussed this in another video. DSCR, debt service coverage ratio. This is the type of loan where the approval is based on rental income meeting the mortgage, meaning if the mortgage itself is $2,000 a month, and again, that has to include taxes, insurance, principal, interest, and HOA, we want to make sure that number is equal to or less than the income on the property, the rental income. So if the property is $2,000, we need to make sure the total mortgage payment is $2,000 or less. Now, again, as we discussed, it can be a little less depending on some of the lenders, low ratio loans and stuff like that. But we're going to talk about the DSCR cash out. Now, after you've purchased a property, remember, when you're making the payments on that mortgage, or when your renters are essentially making the payments, your balance on that mortgage is decreasing, all while the home value is increasing, right? Now, typically the home values are going up about 6 to 7% a year. They were actually going up much more than that several years ago. It slowed down a little bit, depending on the area that you're in the country, of course, but generally, rule of thumb, 6% a year, real estate, okay? So as your mortgage balance is being paid down over the years, your home value is also appreciating, right? Which leaves a gap in equity. So what you can do is a DSCR cash out, where you can go up to, in some cases, 80% loan to value, but in most cases, with most investors that I deal with, are 75% loan to value, right? So that will give you, in a year or two or three, you have an opportunity to do another DSCR loan to extract additional equity. So let's just say you've made some improvements to the home, the value has gone up, the mortgage balance has been paying down. You have the opportunity now to extract equity. And again, we do the loan the same way. We don't look at pay stubs. We don't look at income at all, W-2s. We don't look at any of your debts. There's no DTI ratio, no debt to income ratio. And we do the loan the same way. We make sure that the cash flow of the property is there. We have an appraiser come out and fill out another 1007 and make sure we understand and know what the rental income is on that property. But now we have some equity. So let's just say you have 30 or 40 grand in equity. You take that out, you use that as down payment on another rental property. That property, same thing. The renters pay your mortgage, all while the home value is going up. And then a couple of years later, you take out more equity, and you keep, and basically it's a snowball. In essence, this is a really simple and logical way to grow your real estate portfolio. You're leveraging your existing properties to purchase new properties. And that, again, is how, this guy that has 50 properties, or your uncle has 27 properties, this is how they do it. Like, they don't get approved the traditional way, because that would be impossible. Unless they're a billionaire and can just keep buying, properties cash, right? Which most of these real estate investors are not. They're not very liquid, but they have a lot of cash flow, which in this world is really the only thing that matters. You want to make sure that you have money coming in every month. Yes, having, they say cash is king. Obviously, having cash in the bank is great, but unless that money is making money for you, what good is it? It's like having a bunch of equity in your home and that's just sitting there dormant and not using it, right? Which is, the boomer mentality. They want to be debt free, which, it makes sense, stress-free life. As long as your bills are covered, you're retired. But we live in a different world now. And a lot of these kids and, millennials and now the Gen Z are looking for ways, they're smarter. They're looking for ways to either break out of the 9-to-5 or to avoid the 9-to-5 completely. And, to some degree, we can call them lazy. They're trying to find the cracks in the code and the loopholes and whatnot. But, again, they're also smart. And I think that the purpose of putting these videos out is to target that generation and to also educate those who are trying to escape that 9 to 5, that have been working that corporate job for 20 years and are looking for alternatives to, bring in additional cash flow. It's all about passive income. Obviously we want to work hard and we want to be productive, but at the end of the day, you also want to have money work for you, not just exchange your time for money, So yeah, this is really one of the best ways to go about doing that. Real estate, physical, tangible assets. There's Bitcoin, and then there's stocks, and there's bonds, and there's all sorts of different ways, ETFs you could invest in. But the only real tangible asset, and this has been proven for years and years and years, is real estate. So this is a really good way, and this is basically how those real estate investors continue to grow their portfolios. Sometimes they'll take advantage and they'll sell a property they've had for 10 years because it might have appreciated 50%, and they want to use that to purchase 4 other properties that are maybe 4-unit properties, right? Now their cash flow, they're exchanging the equity in this home for a cash flow that they didn't have. So for example, this home might have been bringing in $1,000 a month, right? 10 years later, they decide to sell it and use it to buy 2 4-unit properties that are cash flowing at maybe $8,000 a month now between those 2 properties. So even though they're giving up that equity, they're doing it for a good reason, because it's all about cash flow rather than cash. So going back to the logistics, 75% is typically where you want to be. I do have investors that also do DSCR second loans as well, where you can actually do a second mortgage as a DSCR loan. So there's a balance, and this is the type of thing, the type of loan where you do the due diligence ahead of time. You find a property, you research it, you talk about it, and you figure out if this is something that if there could eventually be a good return on investment on it, right? If you have questions, I'd love to be a resource for you. Feel free to book an appointment or a consult with me in my calendar link below. And yeah, we can discuss any questions you have. If you have your eyes on a property, and you need me to help you determine the market rent on it, or if you own a property and you're looking to take cash out to buy another property, I would be happy to help you determine what that looks like. This is Sal Bossio with Mortgage Universe. I'd appreciate if you hit the like button on this video, and if you really like the content and you want to see more of it, go ahead and hit the subscribe button. Feel free to share this video with people that you think might have interest in it, other investors or friends that are looking to get into, purchasing real estate. I'd really appreciate that. And yeah, you all have a great rest of your day.